Are we in a recession? How does this affect the housing market? Short answer, possibly. I may even go as far as to say probably we are in a recession. A recession is defined as 2 consecutive quarters of negative economic growth as measured by GDP. Notice here that recessions reflect the state of the economy, not the stock market. We'll come back to that in a moment. By definition, a recession is only visible in hindsight after 2 negative growth quarters have passed, and this means possibly we're already in a recession. It's also possible that one may be looming. Why now, you ask? What's behind this potential recession? In a word, inflation. You know, the Federal Reserve have already raised the interest rates, and they do that in order to keep inflation in check. The Fed is tasked with a dual mandate to control both inflation and the risk of recession. This dual mandate exists because controlling inflation necessarily causes a recessionary risk. But why? To control inflation, the Fed must make money more expensive. When borrowing becomes more expensive, people and companies do less of it, which slows spending and growth. And this could lead to a couple of consecutive negative growth quarters, which is by definition a recession. What does this mean for you? Before you freak out, and let's talk about what this actually means. A recession does not equal a housing crash. A lot of people have it in their head that recession equals a crash in the real estate market. But if you pause and think about it critically, those things don't correlate. A recession essentially means that companies are making less money. A real estate crash essentially means that real estate prices are deflationary. Here's some quick definitions. Inflation, that means prices tomorrow are higher than today. For example, a bag of coffee that costs $5 today will cost $6 tomorrow. Deflationary, that means prices tomorrow are lower than today. That bag of coffee that costs $5 today will cost $4 tomorrow. So if companies make less money, does this correlate with deflationary real estate prices? No, it doesn't. During the 2008 Great Recession, the housing market specifically became deflationary. In other words, that house that cost $500,000 in 2007 might have cost $400,000 in 2009. This happened because flippers and speculators with irresponsible leverage became the market price setters and were responsible for significant deal volumes. Flippers were flipping houses to other flippers, and the market grew to artificial demand from the speculators. They were just hot potatoing between houses, and when this hot potato stopped because mortgage-backed securities collapsed due to default, which dried up the free-flowing credit that the speculators were using to finance their flips, the demand for housing plummeted, and we saw a crash in the real estate market. The consequences of a crash, specifically the subprime mortgage crisis, rippled out into the rest of the economy and caused a recession. Again, a quick comparison. The 2008 recession was caused by the subprime mortgage crisis. Today's inflation and potential recession is caused in part by the forces of supply and demand shifting dramatically due to COVID, which led to stimulus payments and bond buying, followed by subsequent belt tightening by the Fed. It's tempting to think that when one part of the market is deflationary, for example, a real estate crash, it affects the entire market and everything becomes deflationary. But this isn't true. Certain sectors can experience inflation or deflation and can experience it in a self-contained way that doesn't ripple out and affect the whole market. Think about technologies in the 80s. Computers were extremely expensive, but thanks to constant innovation and technology trends, they got cheaper over time and, for example, deflationary. It used to be that only very wealthy people could own a computer, and now most Americans can easily. In 2008, we experienced a recession that was triggered by subprime mortgage crisis situation. The supply of homes built by speculators way exceeded the demand, and many major banks failed and borrowing restrictions tightened. The cumulative effect of this was to exert deflationary pressure on the housing market, which led to a housing price collapse. In 2022, by contrast, we're living in the highest levels of inflation in 40 years. The upstream supply of cost of goods remains high. The cost of lumber is 80% higher now than it was pre-pandemic, partly due to the increased price of diesel, which is exacerbated by the war in Europe, and partly due to the need to pay higher wages spurred by a labor shortage. Homes in the U.S. are built in a lumber-heavy manner as opposed to homes in some other nations, which are built primarily with concrete or cinder block. When lumber prices in the U.S. jumped by 80%, it's no surprise that home prices climbed along with it. And all of this to say, the likelihood of deflationary pressure on the housing market right now is incredibly low. Housing is still likely to remain inflationary, meaning it will cost more tomorrow than it does today. The takeaway, no, we're not heading into a housing market crash. But Kathy, the housing market crashed during the last recession. These two events are linked in my mind. Don't recessions correlate with home price crashes? Fun fact, historically in many recessions, real estate did not become deflationary. In fact, it's often been the case that real estate prices go up in recessions. Here is a chart of the Case-Shiller U.S. National Home Price Index showing home prices over the course of our past 3 recessions, and 2 out of 3 recessions, home prices rise. We are seeing home prices rising, and this is happening because of supply and demand issues. We're seeing a more legitimate demand now from owner occupants as opposed to speculators. We also have record low unemployment and higher wages driven by inflation. These factors combine to explain in part why prices are climbing so much. Recessions vary along 3 dimensions: 1, severity; 2, duration; 3, frequency. It's tempting to think that current or future recession will impact us in the same ways as the Great Recession of 2008. This is due to a few cognitive biases, including recency bias. Our tendency to overestimate that an event that occurred recently will reoccur again, or to assign greater importance to things that have happened most recently. The Great Recession of 2008 was one so recent and so remarkable, it's easy to recall. And that recession was both high severity and long duration, and it felt very personal. Millions lost their jobs, they lost their homes, which meant that this recession impacted us in the most visceral and tangible ways possible. For all those reasons, it's easy to assume that every recession will look and feel and behave similarly to the Great Recession, but will it? Let's turn our attention to 2022 and the many factors that are different this time around. For one, unemployment is extremely low. It remains at 3.6% as of May 2022, according to the U.S. Bureau of Labor Statistics. The housing prices continue to rise despite higher interest rate due to imbalances in supply and demand fundamentals. The cost of materials such as lumber, although it has gone down some, it's still higher than pre-pandemic. Now, I am seeing in the market things that are changing that. You know, for example, builders are slowing down because some people have left the market. Some people have just gotten out of the market. And so some builders are offering incentives, which we hadn't seen incentives in a couple of years. So we're getting incentives. We're also starting to see inventory pop up. So there's some changes, but I can tell you my last couple of listings have gotten tons of showings, open houses, tons of people there. One of them's already gone under contract. The other one has an offer that just came in. So we're still seeing a lot of activity in the market. It's just instead of 20 offers, maybe there's going to be 4. Or instead of, you know, all that strong multiple offer escalation clauses, we're going to see less of that. And honestly, this is where I feel like it's going to help the market, because it's going to give people the opportunity to get into the market and maybe be able to put an offer in and get it. So I know I was going to talk to you about how real estate doesn't directly affect the stock market, but at the same time, investors do react in varied ways, of course, when things happen in the market. As you know, the stock market has gone down as real estate prices have continued to rise. So what are you guys doing in the market right now? Are you investing in stocks while they're low right now? I'm just curious about that. So it's no surprise that, you know, certain stocks have really become volatile. Things that were in the moment, like cryptocurrency and that sort of thing. You know, I don't get involved in that kind of speculation in stocks. I believe that, you know, just consistent investing over the years and not trying to buy low, sell high. I just consistently buy in the market, and that's how I have grown my portfolio over the years. I also have real estate that I've invested in, and I would consider buying another piece of real estate right now. I'm actually looking. So I still feel really good about the real estate market. I think it's going to grow in the Orlando area. What do you think? Do you feel like it's going to stay strong? I mean, I do see how some prices could start coming down, especially in some sectors. Again, it all goes back to pricing the home correctly. If the home is priced correctly in the market, it should sell. But the good news is, as I said in the previous video, if it takes a little longer to sell a house now, that's okay. It's giving people opportunities. It's giving people opportunity that aren't, jumping on houses right away and putting crazy offers on to get into the market and buy something, because you live in the payment, right? So if the interest rate's gone up, right, so maybe you need to buy a less expensive house. You can still buy a house and live in it. So those are some of the things that we'll have to think about in the future of this market, because the interest rates keep going up. So since you live in the payment, you will just need to see with your lender what price range of home you can afford. What is your payment? And then you can still buy a home. As long as it's your primary residence, it's still going to be going up in value, I believe. Now, I know there's people that disagree with me out there on it, but it's okay. I love them. Thanks for joining me today. I'm so happy you're here. I appreciate you so much, and I look forward to seeing you on my next video. Bye-bye now.